If you bought a portfolio and it was creating a 4% dividend and you put 40% leverage on, meaning you put 40% of new money in and you bought those exact same things, that 4% dividend now turns into 6. Now maybe you got to pay a little bit of money in interest, but you've just increased the dividend, and that's how you can get well outside of the range that you typically see. Welcome back to the Investor Mindset Show. I'm your host, Steven Pesavento, and today I've got Steve Selengut in the studio. How you doing today, Steve?
I'm doing real well, thank you.
Well, I'm excited to talk with you because you're 79 going on 80. You've been an investment professional for nearly 50 years, and you just released a book sharing all the details of your income investing strategy program. So I'm excited to get into it because you've been doing something that I haven't heard that much talked about, but it's a really cool strategy. And so before we get into that strategy and some of your background or how you got here, I want to start all the way by looking back at your childhood. What events or influences from your childhood shaped who you are today, Steve?
Oh, geez. It's probably, it might have been later, but my childhood and the way I got into thinking about money and investing and stuff like that was pretty much the fault of my dad, who was a real estate investor. And he was a builder and developer. And we lived on a place called Lake Opakong in Northwest Jersey, and he was one of the first developers there. In the 50s he started. That's about the time we moved out there, that I moved out there. I was about 5. But what he developed there was what you would call a vertically integrated operation. Meaning he owned things from the lumber yards where he bought the materials to the land. He financed the homes he built for the people, took back the mortgages, and insured them. You know, and later on when I got into college and I started reading about vertical integration, oh yeah, that's what he did. You know, it was that. But what he did for me and I used to do things like mow lawns and teach water skiing and things like that. But what he made me do was put away a little bit of that, 25% to be exact, in a savings account and start seeing the interest. He wanted me to look at that and understand that these guys are paying you money for your money. They're holding your money and they're paying you for it. And the income you're getting looks like it's peanuts now, but just think about how that will grow over time when you do that. And on a larger scale, as you start to have a profession like I have, you'll be able to put lots of money back to work in different ways to generate more. So it got to the point that, eventually I was hooked on the idea of making money and of investing it, and right into college. I mean, fraternities and sororities and how does Steve make more money was pretty much the mindset.
I think it's so cool because by seeing the perspective of a real estate investor, somebody who is operating a full business from top to bottom. They've got all these individual pieces. They're making money all along the way. But then on top of it, they've got this consistent income stream coming off the properties, coming off the mortgages, coming off the operations of the business. So you're seeing the power of having that income, and you're learning very early that that's really important. And then I know you pivoted away from real estate. You started focusing specifically on investing in the markets. And what I think is so interesting is, you just sold your practice, you're going on 80, you look like you're 65 or less. We got to talk about some of those secrets at some point. But the fascinating thing to me is that you were an advisor, you sold your practice, had 100 million of AUM or more, and you were creating 6, 8, 10% income streams for people while investing in the public markets. And that's something that's so far off for me because, I run a real estate private equity firm. We invest, we're creating big returns on exits, and we're creating, great cash flow on the properties. But being able to create that kind of return in the stock market from an income standpoint is something that seems so far off to me. So tell me about this vision and this target of income over market value and how that led you down this path.
Well, the income, I think everybody has that need for income. They want to have. We lived on a lake. We had to have a boat. We had to have this. We had to do that. Depending on who you're married to, they have different needs, from recreation to dressing to entertainment and all these other things. And if you want to really live life, and I had a pretty good example from my parents because they lived pretty well and they traveled a lot, and I wanted to do that too. They took me and my wife with them occasionally. So we developed this bug for traveling, and you just can't do that without significant cash flow. Mm-hmm. So as soon as I got involved, as soon as I got my hands on that first pile of money, I was very fortunate and chose my parents well, as they say. So when I got out of college, when I got to be 25, I got to take over what he had put together, both from my little bit of contributions, from what was left over from my college fund, and I was given the reins. And when you get something like that, the first thing's on your mind, you sure don't want to lose it. So I was looking at safety. My broker's name was Rita Akers, in fact. And she and I went, and I said, I want to grow it, but I don't want to take risks, big risks. I've already got this. This is pretty substantial. And I want to generate income from it so that within X years, I can thumb my nose at my employers and be independent with the income and maybe do something on my own, start my own gig of some kind. I sure didn't want to go into real estate because that was a 7-day-a-week job. And as it turns out, so is money management. But I didn't know that at the time. Anyway, so that's how the income focus got there. I had a goal in mind. I wanted to get out of commuting to New York. It's not fun from North Jersey, particularly in the winter. I remember being trapped outside a Giant Stadium for hours, sitting in traffic while they tried to clear the snow and the accidents and all that stuff. You never knew when you were going to get home. But anyway.
Well, there's a concept I talk about, which is called name your number. It's all about understanding what is that amount of money you need to earn consistently, passively, every single month to live the life you want to live. And there's so many different ways to do that. But one of the ways that you've been able to do that and do that for your clients is by focusing on what are called closed-end funds. And I don't think a lot of people know about them. And obviously there's only a couple hundred of them available at any given time to invest in. But let's dive into that strategy and let's break it down first into what they are. And then let's talk about where the advantage is, because there's some technical information here that's going to be really valuable for people to be aware of. Because at the end of the day, the reason to be an investor is to be able to create that consistent income that you can count on. And this is one strategy.
Well, yeah, CEFs are unique. I didn't really discover them. It was almost accidental that I discovered them. I was mainly a stock market person, but I always a dividend stock person. From what my father had told me, never put your money with anybody that's not giving you something in return. And dividends were two things. I mean, they gave you something else to reinvest, and it was an easy way to determine if a company was in trouble or not. Because if they cut their dividend, you knew there was something wrong upstairs there, So I always started with dividend stocks, and what I thought was a dividend stock, a couple of them turned out to be closed-end funds because they trade like stocks. But their income was attractive to me, particularly one called Petroleum and Resources, which used to pay huge distributions at the end of the year. But anyway, income was my focus. Like you said, and I backed into CEFs, and then after 2000, I really started picking up on the income variety of closed-end funds, because what they did, and this is an important key element of closed-end funds, they own corporate bonds, treasuries, preferred stocks, for example, and these are very illiquid when you deal with them individually, as I always had. And there are markups associated when you trade bonds. The broker gets a percentage each way and things like that. But with closed-end funds, you've got hundreds and hundreds of bonds in one portfolio that you can trade like a stock. So you're trading, you have liquidity in an illiquid market. And the things are paying a much higher rate of income. Now, back to what's their difference. The biggest difference is a closed-end fund is a trust. It's a pass-through trust. So their objective has to be production of income for their shareholders, because they have to throw out all the income. They can't reinvest their income like an Amazon or a Microsoft or an Exxon. They can't go out and build another plant, or do anything like that. They have to give it back. So their goal has to be to grow the income production that they have in hand. I mean, that's their factory. So that's the main attraction of closed-end funds. They don't have anything else on their mind. They don't care about growing their market value or their net asset value. Even they're concerned about getting you income, and that's why they were so attractive to me, because they contained everything else I could imagine. Every common stock, every hero you hear about, your NVIDIA, now that it's the big deal, or Amazon, it's all in there. And the equity closed-end funds contain hundreds and hundreds of stocks. So you still own everything. It's all the same stuff. People talk about gold. You can buy closed-end funds that invest in gold. Real estate, lots of different real estate type investments, both for land and development and for rental type properties. So they're just a package that you can do all that in and develop a diversified portfolio, no matter how much money you have to invest. Even my smallest clients could have a piece of the action. A $30,000 portfolio can own every stock on the New York Stock Exchange.
So what's so cool about this, just to underline it, it's a trust that's essentially a vehicle. They IPO, they sell a fixed number of shares, and then they go out and they go and buy equities, bonds, whatever it is. But they have to distribute that dividend or that interest from the bond at the end of the year. 95% of it has to go back to the shareholders. And then the way they earn money is they get a small percentage, 1 to 5% of the income that's distributed. So they're actively focused on, and their incentives are aligned to distribute as much income as possible.
Right, they're focused there. Their fees are higher than mutual funds and ETFs, maybe even higher than some financial advisory firms. But the customer, the shareholder, doesn't pay any of those. The returns, the interest, the dividends they get are after all the expenses are covered. So they're expensive, and they don't meet the requirements of 401k investing as set out by FINRA and so on. And they don't have as many, and I don't know if this is a drawback or a benefit, but they don't have as many shares on the market as the other ones do. So they become more volatile. And I know volatility scares a lot of people, but I see volatility as opportunity.
So let's get into the volatility in just a second, but just to kind of underline this thing. So these closed-end funds are creating between, 6, 8, 10, 12% distributions every single month, quarter, or year. They are very much similar to an ETF or a mutual fund, except that they have the ability to take on leverage, so they can actually buy more of that, with the incentive of using that to create more income. And the other thing that you mentioned was that they trade at book value instead of market value. So there aren't mark to market automatically, which is where that volatility piece comes in, where you can buy something at a discount and then sell it and create additional capital gains. Is that right?
Yeah. The ability to make a profit doesn't just come from buying it at a discount to its net asset value, because
Sure.
its net asset value is separate from the price. Price operates like a stock, so you can buy it at a premium and still sell it at a higher price later on.
Yep.
I mean, so but you got it. That's the way it operates. It's similar to the other two. It trades every day, so that makes it a little different than the mutual fund. It's got much fewer shares because it doesn't manufacture them on demand like the other two do. So they don't have to buy. They don't have to sell shares either. And in fact, I was just reading that in a question on Google, that one of the advantages is in a market where the managers of a mutual fund have to sell shares because people want their money back when they want to sell their units. A closed-end fund manager doesn't have to do that because they're trading. The stock is traded between you and me, not you and the fund. So it's a lot. It's got differetions, but it's really a simpler tool than the others, and I find it simpler anyway.
Well, so there's two things when it comes to closed-end funds that I think people without deep knowledge might throw a flag up and say, hey, I don't know about this. The first would be the fact that they use leverage, and there's a belief that maybe that creates some kind of strong additional risk. And the second would be that their fees are higher than an index or a mutual fund. So let's break both of those down and talk about the advantages and disadvantages of leverage, and let's talk about those fees.
Well, let's talk about leverage, for what it is. You're a real estate developer.
Yep.
Nobody goes out and spends $20 million on a tract of land out of their pocket. They borrow money from a bank. Yeah. It's only called leverage when they talk about closed-end funds, but that's leverage too. All leverage is buying to run your operation. If you're into rental properties, you buy something with a loan, but you know that you're going to get this much rent and you're going to take care of all the expenses. The same thing goes with the manager who's running a fund of securities where he invests in things. If he can borrow money at 2% and reinvest it at 4%, that makes it a good deal. When interest rates were near zero, how many of us went out and took one of those loans, those additional loans against your property because you could borrow money at 2.5%? And for me, you could have even invested in dividend stocks at more than 2.5%. So it was like found money. It was easy. It was a way of doing business. And how many corporations out there operate without leverage? They don't call it leverage. They call it liabilities. They call it loans. They call it debt. All leverage is that simple debt. It's just like you going out to borrow money to buy a car. Yeah. It's the same principle.
It has a huge advantage because it allows you to increase the rate of return because you're buying more of what that asset is. But kind of talk a little bit about that and what kind of leverage they typically use.
Yeah, that's exactly. They use two types. Basically, they sell preferred shares, which, they're going to be out there for a long time. Let's say they sell them at 4%. They have that money to put to work at above 4%. And of course, if the market's at 0%, they don't sell a preferred at 4%, right? So, it's that type of thing. You exactly what you said. If I own 100 different stocks for these particular shareholders with the money that they invested, I then go out and say to the bank, hey, I've got this, $400 million in capital here. I can borrow up to $200 million, but I'm only going to borrow $100 million from you. I'm going to take that $100 million. I'm going to add that to my pile of securities. So my shareholders are getting distributions not only on what was purchased with their money, but was purchased with the borrowed money as well. So it's exactly what you said. The cash flow of the fund increases, and they have to pay out 95% of that to me. So that's what leverage is all about. It's a loan like any other business anywhere would do. It's nothing to be afraid of. It's not a margin loan. I think a lot of people, and I'm not pointing fingers at investment advisors or brokers or people like that. I think a lot of people allow individuals to think that these are loans against the securities in the fund that the trust manages, and they're not.
Mm-hmm. I think that's a really important thing to underline, because the concern people have is that, oh, well, hey, what happens if the value of those shares go down and that leverage is going to get called back and there's some kind of issue? But they're taking short-term loans, but short-term loans in this case are 2, 3, 4, 5, 6-year loans, not 10 or 20-year loans. And by the best example I can that I've heard you talk about is that if you bought a portfolio and it was creating a 4% dividend, and you put 40% you put 40% leverage on, meaning you put 40% of new money in, and you bought those exact same things, that 4% dividend now turns into 6. Now maybe you got to pay a little bit of money in interest, but you've just increased the dividend, and that's how you can get well outside of the range that you typically see. So that's really, really powerful. And it seems like a no-brainer, because these people are incentivized because the fees they make are only based on the income that's distributed. But when it does come to those fees, what's the pushback that you hear? And how do you speak to that pushback around fees?
I think the fees are AUM, just like normal fees. I don't think they're based on the income. Okay? They're based on the market value. I'm pretty sure. I'm not sure I ever really looked into that, but I'm pretty sure they're normal that in that manner. But that comes out of the overall pot, and it doesn't. No shareholder, no client of mine ever saw a bill from any of those closed-end funds for any fees. The returns, the dividends, the distributions were always after fees. So they're really not important. It's the like I used to criticize the government and their regulation of 401ks, where they say you can't have fees over 1% or 1.5% or something like that. So you have Vanguard, who has all these 0.4%, 0.04% fees and so on, and they're paying you 4%. So I say, what's better, 4% after a little fee or 8% after a big fee? I mean, give me a break.
Yeah.
So yeah, So
that's a good thing.
That's a really that big a deal.
It's a good thing to underline that when they're looking at this, it's the distribution is net of fees. So if you're getting 8%, there's no additional fees coming from that CEF.
And even when we were managing money, when I was a professional, and I was charging a fee, so they would have me to pay, and if I were getting a 1.4%, what I used to tell them was very simple. I said, my goal here is to make you more in capital gains than you pay me in fees. And it's not difficult with the volatility of these things to literally, in 2021, we made the same amount in distributions as we did in capital gains.
Wow.
Or capital gains the same as distributions. That had never happened before. 2021 was a really amazing year. But I can tell you honestly that so far this year, I've already made in capital gains in my own account the equivalent of two months total dividends. So my year this year is going to be at least 14 months long financially.
Yeah, that's huge.
So
that's really huge. And so I think there's something where it's like I'm wondering, and I'm sure listeners are wondering as well, it's like this makes a lot of sense. We're going to create a very strong income. It's going to be net. We want to build up our income stream. So obviously you had a firm, you were doing this actively, and you've put out this book where people can learn it themselves, and you advise some people in a one-off way to help them get there. But for the people who are listening who want to start diving into this deeper, how do they start doing due diligence? And nothing we're going to talk about today is financial advice. But how do they start doing due diligence and finding those right opportunities for the income side, let alone the potential capital gain they could earn?
Right. There are a couple of websites. The one I use for my research is called CEF Connect. and it has probably around 400 or so closed-end funds of all types, taxable income, tax-free income, and equity, and combinations. There are mixed animals out there too, and they can screen them in many, many different ways on that website. Look at the yields, look inside, see what kind of securities are inside, how concentrated it is in any the first top 10 numbers. You can look and see how many I said that already, securities inside. You can see how long it's paid its dividends and how consistent that's been, and have they moved in sync with either the market or the history of interest rates. And they do move more along with interest rates than they really do with the stock market, because they're what we call in the field interest rate sensitive securities, just like mortgages and even utility stocks are in that same category. So this CEF Connect, it has some educational information in there that you can look at. You can find out what they say about both leverage and return of capital and their fees and charges. There are probably 60 different financial institutions that provide closed-end funds to the public, but you almost never, if ever, hear an advertisement from a Blackstone or a BlackRock or a Nuveen or Eaton Vance or Gabelli, any of those, even though they are big players in it. And why that is exactly, I'm not totally sure. I'm pretty sure I understand why they're not popular with the financial community in general, and it's probably because of this interest rate sensitivity. There's two reasons. If you were Amazon or Exxon or any of the big type of companies like that, and your structure made you reimburse your shareholders 95% of anything you made, you wouldn't be able to grow your business. You wouldn't be able to grow your net asset value. These securities are not designed to compete with mutual funds or ETFs or even individual stocks, because they have that limitation. Their earnings are going back to their shareholders. I think a lot of us would like to see a world where the corporations of the world pay a little bit more respect to their shareholders, but I don't think we'll ever see that. So this is the opportunity to get that.
So you can go to CEF Connect, you can do some research, you start looking at what the dividend is, what kind of assets are being owned by it, what's their leverage, what are their fees, what does that distribution look like to you? But what else can somebody do? And what are the things that you look for that allow you to make a decision saying, hey, this seems like something that's good? Now, you're an active trader, meaning you're taking profits when they're available. But what is it that you're looking for in order to do that? And what would someone look for if they were more interested in just a buy and hold strategy, whether you agree with it or not?
Okay. Just like, and really there's four things I'm going to mention. I'm really a low risk, if there is such a thing as a low risk trader. I mean, I don't feel that I'm trading actively, but I don't feel I'm trading risky type securities.
Yeah.
And the way I determine that, and I did pretty much the same for I call them the 4 pillars of risk minimization. I did exactly the same thing with individual common stocks when I was growing up in the field. The first thing is quality. The first thing you got to look at in any security is the quality. And some of the things that I use to judge quality is, in a CEF, it's how long it's been in business. I don't own any, or at least very, very few, that have not been in existence at least 5 years. I don't buy any no equity fund that pays less than 5%, no taxable income one that pays less than 6%. They must be diversified inside. They have to own at least 50 different companies, or 50 different bonds, or 50 different preferred stocks inside. The average in the selection universes that I have are, over 300 in the income side and over 200 in the equity side, different issues inside. So that's a big key. So those are the things I'm looking. How big is this company? How many other closed-end funds do they have? Are they a big operator in the field? The profitability of the companies are the same as you can judge that by the distributions of the CEF. So I look at the quality of the company, the quality of the ownership, the quality of the cash flow. The second one is the diversification within the security. Just like a multinational company in many industries or many sectors is a safer equity bet than somebody who's got one little, the guy who produces buggy whips and that was it. The first car gets developed and he's out of business, and it's the same for any big company. You don't want him to be a one show pony like that. So diversification inside the fund is important, just as it is in the portfolio itself. The next one is income generation, which I mentioned. And the third one for risk minimization is profit taking. And so I look at what I want to see in one of these funds. I want to see extreme volatility within a range. If you look at a chart over the last 20 years, you can see the trading range in these things is very narrow, because they move in price relative to the changes in interest rates more so than changes to in the stock market. And that's true of the equities too, because when the stock market goes up, these guys are a little bit different. They take profits rather than the buy and holders holding on to the good ones, getting rid of the bad ones. There's one famous manager who says, keep your winners and sell your losers and let your profits run. And that kind of gets you to zero in an extended correction, doesn't it? But that's the attitude on Wall Street, is that anything that doesn't go up in price, it's automatically a loser. You have to look at things with a different purpose when you're dealing with closed-end funds, because their purpose is really income generation, not market value growth. So as long as they're producing, it doesn't matter to me really which way they go in the way of price. Historically, they stay in a pretty distinct range. So I think that's answered the question. Those are the four things you got to look at in any type of investment, be it a real estate investment trust, a BDC, a master limited partnership, ETFs. Everything you buy, no matter what, you got to check the quality. You got to stay diversified. You got to have income. And one of the things that I add that most people don't is you got to take your profits, because we've all seen them disappear almost overnight. I think March of 2020 is the biggest example, where we had a huge correction that lasted 2 months, and it was gone. But the panic that existed for those 2 months was very, very real. Most corrections take a little longer than that.
Yeah, that was a very, very fast moving action. And so the bottom line about these closed-end funds, and right, you don't run one, but you were running an investment firm, and this was one of your key strategies. But one of the big things about closed-end funds is that you're looking specifically for income generation, and you're looking for income generation that's higher, at a higher percentage per year than what you're going to get if you were going to go buy those individual securities on your own. And you don't have to be actively managing. There's a huge opportunity, it sounds like, if you are willing to learn the strategies about how to pick them and understand what their value is, that you can actually create even more capital gains by moving money between different ones. But at the end of the day, you can create an income stream that you can live off of, and it's at a much higher rate than you would in the traditional market.
That's absolutely correct. There are three streams of income that people have, and it's the distributions from their assets, the capital gains, that they can generate by selling those assets and buying them back again. And then there's always, if you're lucky, you get that rich uncle that sends you money every now and then.
We all don't have that rich uncle, so we better rely on those first two. So, Steve, what I'm curious about is you're at kind of a different chapter of your life. You just sold your company. You just came out with the book, Retirement Money Secrets. You guys can buy it on Amazon. I absolutely recommend you guys get a copy if you want to learn about this. But you're kind of at a new phase. And so what was it that drove you to put this information into a book?
It's I've had a history of writing articles about a lot of these things, and I had one book out before called The Brainwashing of the American Investor, and it was more of a textbook type thing where I explained bonds, I explained stocks, I explained my process and things like that. And most of that hasn't changed, but this one is more focused on income through the use of closed-end funds and through the trading of closed-end funds. And I don't know. I just feel like, I've had probably 250 clients over the course of my career. So I've touched a number of lives, and most of my clients, my old clients, are still with the firm I left, and are still there, and they're happy, and they're still getting good income. But it's a really small number of people that know about this. I mean, one guy said, I just talked to my banker today, and I told him I started doing this in closed-end funds, and he said, "What? With what?" People don't know they exist. They are the oldest fund security on the planet. They were around before mutual funds were. I didn't know it either. I mean, in the tests that I had to pass to become an RIA, there was not one question about closed-end funds or that they even existed. And and people just haven't been schooled on what they are. So my goal in the remaining years of doing this is to help as many people as possible learn about them, start to use them, and spread the word about them. I mean, I've sold a bunch of books, and I've probably influenced about 100 people so far, and that's a short period of time. So if I can keep at that pace, I'll more than do what I did by managing the money individually.
Yeah, think about the compounding effect of being able to put the information out in a public format, be able to teach people. Obviously, you've made your money, you've got all of this income coming in off your own closed-end funds. To be able to pass something along to the next generation, I think is a beautiful thing. So I've got one more question before we wrap up. Why don't you share with folks where they can follow you, or where is the best place to get a copy of the book?
Well, the best place to get a copy, of course, is Amazon. Although a lot of people would prefer using Apple or even Barnes and Noble and stuff. It's available everywhere in both ebook, hardcover, and paperback. So you can get it anywhere. It's not in audio yet, but we're talking about it. It's tough because it's a conversation with me and a couple other people, and there's a Q&A with a Facebook group, and all these graphs and charts. How do you do that in audio? I don't know. Yeah. Anyway, so that's where you can get the book, and I think that would be you'd learn something from it. At least you'd make at least the $20 you paid for the book if you read it and do something, anything.
Yeah, absolutely. Well,
go ahead. I have two Facebook groups. One that is purely about closed-end funds, and the other one which is called the Retirement Income Independence Coach, where you can get on there and you can ask all your questions and somebody will answer them, even if it's not me. There's almost 1,000 people in that group already, and they're very free with their time, and they'll be very helpful. I have a website called theincomecoach.net, where you can learn specifically more of the services I provide to people.
Well, that's amazing. Well, I really appreciate you putting all the time in to put a book together and share these things. As we wrap up, for the people who are listening and they're thinking to themselves, this sounds really good, but it also sounds overwhelming to get started. Obviously, they should go buy a copy of the book. What are some of those first steps that you recommend for them to wrap their head around it and make a move towards focusing on income?
Yeah, I think either reading the book first or going to ClosedEnd Fund first and checking out a few possibilities, and looking at the histories of the distributions in all of them. Those are the kind of steps I think you really should take. Look at your own portfolio and see what real base income you're producing. I mean, most portfolios generate less than 3%, even if they're professionally managed. And if they are, talk to your guy and say, hey, I want to make more. I want to have more income generating so I can go traveling, so I can do this and that. And here's a book, buddy, that'll show you how to do it. But I think that's some first steps. But check it out. Do some research. Go to CEF Connect. I think it's a good place to start.
Amazing. Well, Steve, thanks so much for joining us, and thank you all for listening. We'll see you on the next episode. Thanks for listening to the Investor Mindset Podcast. Make sure to hit that subscribe button. And if you'd like to watch another, here's one up top. And here's another great video right down below.